Treasury, we keep getting asked how we're going to deploy that capital, and quite frankly, we're just hoarding it. We don't have any large capital expenditures coming up, and I like seeing it build, and it's continually building. We expect to end the year off on an extremely positive note. We're probably going to end up with somewhere around $600 million in the treasury by the end of the year. We did about $98 million in free cash flow in Q3. Our production was twice what it was a year ago. That's as a result of our major acquisition in January, the Gatos silver mine that we acquired, which doubled our production effectively. So it's just been great all around. Looking forward for a positive end of the year.
Absolutely, no, and with a silver price north of $50, I think you should be seeing what is actually your sales price per ounce of silver last quarter?
I think we're close to 40. I think just slightly shy of 40. I think we beat the COMEX by maybe 50 cents or something. It did spike a lot. End of September, in October, we saw basically $55 silver.
Not only is silver rising, this breaks models analysts and institutions have used for over a decade. The consensus for years was that silver would lag gold, be restrained by paper markets, and fail to break above 2011 highs. That old playbook is gone. This rally is unusual, according to Keith Neumeyer. A metal that the world has undervalued for too long is structurally repriced. A vital metal recognized by nations. A metal whose supply chain is breaking under industrial, strategic, and global demand. The newer version is straightforward. His $40 silver by 2025 demand was violently erased. Silver reached mid-50s, sold off, and is now poised to attempt all-time highs. This moment's power comes from something other than price activity. Reason behind it. The 2010 to 2011 silver rise was nearly entirely caused by paper shorts that had to cover. This time, Neumeyer says rocket fuel comes from the physical market. Silver's key mineral status in the US was a psychological turning point. It woke institutions, mints, refiners, and strategic buyers to the fact that the world needs silver, not its energy grid, AI, nuclear power, data centers, or transportation electrification. Silver stocks are plummeting. Shanghai warehouse levels are at 2015 lows. Over 5 years, global shortfalls reached approximately 1 billion ounces. Miners can extract 850 million ounces annually, while the world consumes over 1.2 billion. Investment stockpiles and strategic reserves cover that gap. An inexhaustible supply. Silver isn't only rising, its structural shortage requires higher prices. Today, Keith Neumeyer's fresh study and Gary Wagner's technical road plan will explain this. Please like this deep, data-driven, non-sensation urgent video to spread it. Subscribe and enable alerts. Please enjoy the video and thanks for supporting us.
Where we exceeded $560 million in the bank. It's an enormous treasury. We keep getting asked how we're going to deploy that capital, and quite frankly, we're just hoarding it. We don't have any large capital expenditures coming up, and I like seeing it build, and it's continually building. We expect to end the year off on an extremely positive note. We're probably going to end up with somewhere around $600 million in the treasury by the end of the year. We did about $98 million in free cash flow in Q3. Our production was twice what it was a year ago. That's as a result of our major acquisition in January, the Gatos silver mine that we acquired, which doubled our production effectively. So it's just been great all around. Looking forward for a positive end of the year.
Absolutely, no, and with a silver price north of $50, I think you should be seeing what is actually your sales price per ounce of silver last quarter?
I think we're close to 40. I think just slightly shy of 40. I think we beat the COMEX by maybe 50 cents or something. It did spike a lot. End of September, in October, we saw basically $55 silver, and I think that our Q4 average will be probably much higher, I would expect. The integration was flawless, and our team, I think, did a fantastic job, putting all the IT systems in place and all the control systems. It takes time, and it's not a simple process to do. Now that we've done it, it's all fully integrated. Now we can focus on Jarrah Canyon. We're getting approached, as you can imagine. When it was running, our all-in sustaining costs were $2,400, and gold was trading at $1,600 at the time. So, we were losing money, and in hindsight, we probably should have shut it down sooner. But we didn't, because we thought that we could just keep running it, and gold didn't cooperate, so we made the right decision ultimately. But no, it's a great asset. At $4,000, $4,000 gold, it has over 8 million ounces of gold, economic gold ounces. And the mill's got a 5,000 ton a day capacity. It's super strategic. It's got one of the only 3 roasters in the entire state of Nevada. So no, it'll get turned on. We'll be coming out with some news in the next probably 3 to 4 months on it. And at that point, we'll talk further. The nice thing about it is all the contracts, the legacy contracts, which were really aggravating for us at the time when we were operating it, are all force majeure. They're all gone. So when it gets reopened, it's going to be our own people, our own fleet. It'll be all self-mining. The same as we do in Mexico. We won't be using a bunch of contractors and
Okay, perfect. No,
so it'll be totally different.
So you're in full in control.
Yeah,
right.
Exactly.
Keith, you were speaking yesterday on stage as well, and you mentioned you're looking for more acquisitions as well, opportunistically, of course.
Yeah.
But solely silver, or you highlighted silver, of course, as the number one focus here, because you want to remain a primary silver producer. So challenging you a little bit now, bringing Jared Canyon back, like that screws up the ratio between silver and gold again. Are you going to offset that?
It's a good question, and it's becoming more difficult, as you can imagine. With all the different acquisitions that we've been seeing in the Soar space, it's getting tight out there. And we spent a lot of time looking at the juniors, and we're invested in some of the juniors already. What our next M&A transaction looks like, I can't really comment on it today, but we were quite active. We don't want to become a gold company, and we see many of the other players in the silver industry becoming gold companies. We're trying to prevent that as best as possible. By getting Jared Canyon up, it will obviously add some gold ounces, but right now we're at 57% silver. We're the purest in the silver space, and it's important to us. We're trying our best to keep it up to those levels.
Fantastic.
According to Neumeyer, this is the largest significant silver market difference since 2011. Silver's previous significant run from $30 to almost $50 was paper, a tremendous short covering panic as banks were caught offside. That rise ended swiftly because paper demand can vanish suddenly. This time, banks aren't trapped. The world is. Physical buying from governments, industrial consumers, nations preparing for geopolitical competition, and a public realizing how important silver is driving this surge. Prices must skyrocket or metal runs out. Neumeyer is clear. $50 is insufficient. Even $60 is insufficient. Mining production cannot increase at current prices. Only a prolonged structural silver revaluation will keep the system running. Let's continue to the second important clip, where Gary Wagner meticulously explains what Neumeyer warns about.
Can't believe I'm saying it, but I'm looking at the chart, so it must be true. And then it came down. But if you look at the amount that it came down just below a 61.8% fib retracement. That comes in at 39.62. The lows that came in, there's a tail that came in around 39, but these real bodies came in around 39.40. That is an acceptable correction when we consider gold ran from 3680 up to 4400. You're going to get corrections. You're going to get profit taking in a bull market. A 61.8% retracement is absolutely acceptable, excuse me. And if I can put one more number up there, if I can see it, a 78% is also extremely deep, but acceptable. It's not up there, but the 78 would have taken us probably to these lows right here. So you've got gold still in a fully bullish demeanor. And when I say that, that doesn't mean it's going to go parabolic straight up forever. What it means is that as it goes up, it will correct. And when it corrects, it will correct an acceptable amount. A correction more than 78%, we start to question whether or not we are shifting or pivoting from bullish to bearish. Right. A move just below 68% is really an acceptable correction. Now, here's the thing that does concern me. And that is, it came down to a 61.8% retracement, a little bit below that. Then it moved back up on Thursday, November the 13th. We hit this high, and then we've seen it come down for the last 3 days. That is not what you want to see. That could be indicating, to me, it says we're getting a consolidating trend. We're getting a range-bound market. I am not ready to say we've gone from bullish to bearish because the chart doesn't suggest that. The data doesn't point to that. However, a hard break below, call it 39.60, maybe even to like 38.90, then it brings into question whether or not this bull market is over. But if we kind of compress this even more and take a look at what preceded this move, and we're going back to the beginning of 2025, can you believe at the end of last year, beginning of this year, gold was sitting at $2,600 an ounce. I mean, that's a huge, huge move, considering it moved from 26 to 44, almost a doubling in price. So when you get this kind of a move with really no huge correction, if you look back at the end of December, it's at 26. It's where my cursor is. It comes up, you get a small correction. You got this one correction here in April 2025. It's at 31.92. Let's round it up to 32. And then it comes down to 29. Really acceptable correction. Pops up, you get this double top, and then it comes down to about 3,100. Again, a very acceptable correction. From there, it kind of slowly meanders, no real corrections, and then where the box is when I'm labeling it as the beginning of this parabolic move from 3670 up to 4,400 plus. So the fact that it went up to 4,400 plus and came down just below the 61.8% retracement, in pure technical terms, to a chartist, and I call myself a hybrid trader in that I acknowledge fundamentals move the market, but technicals and numbers are a way for us to kind of gauge where it is within a trend. This kind of move from 4,400 down to about 3,900 and then popping back up is an indication of a healthy correction. Now, what we need to see, and this is the one thing that I haven't seen, and that is it does pop back up, but now we have a lower high. So 4,200 here in the middle of November, 4,400 at the absolute top. That doesn't mean that the bull market is over, but it throws kind of a wrench in that idea because the fact that it came down and then made a lower high. Now, it's only been 3 days that we've seen it come back down, so we could see it turn back around. We know that's going to be fundamentally based. Everyone is expecting a rate cut by the Fed, but I believe that that has pretty much been factored into the market. Mm-hmm. The question is, we do not want to see gold break back below, call it 3,900, which is below the 61.8. We certainly would not want to see it go to 3,800. That could bring into question whether or not we're witnessing the end of it. Right now, we've got a range-bound market. We've got highs at 44. We've got lows at 39. It's a wide spread. And the one thing that I am concerned about from a bullish standpoint, doesn't mean it won't turn around, is the fact that this high here compared to this recent high, middle of November, is a lower high. Right. You typically don't want to see it, but trading's not over yet. The month isn't over and the year isn't over. We could get a Thanksgiving or Christmas rally. We've seen that happen before. The bottom line is gold is going to move not based on what we see in a chart. A chart simply reflects what has gone in the past and helps us make sense of it. But most importantly, it's the fundamental news that comes out. Yeah. And a rate cut, of course, is a positive bullish factor for gold. Gold tends to work best in an environment when fixed yields are lower, because higher fixed yields draws investment money into that asset class. So it's only one rate cut that we're looking at, but we start seeing rates getting cut 2, 3, 4 times. That's a different story, but that's not what they're saying. And then the other thing I do want to mention about rate cuts is the Fed's going to be I'm surprised they're cutting rates with inflation near 3%. Troubled by now is that this current rally kind of fizzled at 4,200. We've had 3 solid down days. If in fact gold turns around, and we've seen that happen before, I'm trying to look at the chart. Typically, recently, we don't get too many red candles. That's where it opens and then closes lower. That's something like this red candle. Green candle simply means it opens and closes higher. You've gotten 3 red candles right here. That's actually a candlestick pattern called 3 crows. It can represent a bearish continuation, but here it did not. It then found support at this level, a logical level, right around the 61.8. It came up and now it's moving back down. We don't really want to see gold make a lower low than say 39.40. That's these lows that came in through October. That would bring into question whether or not we've gone into either a bear market or more likely a range bound market.
Right.
Because when you see gold move as much as it's moved, as fast as it's moved, you're going to get corrections, A, and B, you're going to get points in which it consolidates. It forms a base. And so after it comes up, it comes down. And this area here from, call it the end of October through the first week of November, even though it's not a straight linear line, you do have a range in there. That's a range. That's a consolidating market. But it did find support here. It popped here. As I said, the only thing I bring into question is you would like to see gold come and challenge the all-time record highs and to make a higher high. The fact that it's come down for 3 days doesn't tell us yet that the bull market is over, but it tells us that it didn't have the ability to make a higher high, and that brings into question whether or not this bull market will continue. I am more likely to believe we'll see range-bound activity, especially through the holidays, unless there's strong fundamental news to push the market up or down in either direction. It's as likely that the volume, and you can see it's decreased just a little bit. See how strong the volume was during this uptrend. You can see the volumes come down, and we are going into a holiday season. Traders tend to, rightfully so, want to spend time with their families and not stare at charts and take a break from the activity. So we can get moves that are exaggerated because volume goes down. Whenever you get thin volume, it takes less to move a market in either direction. So the key is that gold needs to hold above 3,900. If it does not, that tells us one thing. Even if it comes down to, say, 39.60 and moves back up,
Gary Wagner's investigation reveals Neumeyer's warnings aren't philosophical, clearly noticeable on charts. Silver acts as an asset long out of its trading range. It breached ceilings, set a new high, and is testing support before two explosive continuation moves. Meanwhile, gold quietly confirms the story: higher lows, tightening consolidation, and a bid that refuses to break even under profit-taking. The market loses trading sentiment when both metals flash the same shape. Trading scarcity and shortage is what Neumeyer has been warning about. The physical depletion from Conx, London, and Shanghai drives silver's new direction. Wagner's charts show what Neumeyer observes on the ground: stockpiles falling, premiums rising, and delivery needs rising. Thus, fundamentals and technicals have aligned. Last time, the 2009-2011 cycle created one of the most violent vertical precious metal rallies in history. Silver today has a multi-year deficit and industrial demand. Unlike then, Wagner's technical roadmap predicts that silver will repeat those mid-$50 highs and exceed them, redefining the precious metals market. Silver breakouts are not isolated. Gold follows silver. Gold breakouts change institutional portfolios. Physical inventories are stressed when institutions change portfolios. This is the current feedback loop: shrinking supply, rising structural demand, and chart patterns indicating higher highs in the next major rise, not months from now. As Neumeyer's basic alarm and Wagner's technical confirmation unfold, the message is clear. The precious metals market is changing from the last decade. This is systemic transformation, not a rally. If this breakdown was helpful, like this video to spread it. Subscribe if you're new and enable notifications to never miss an update. The coming months could be momentous for gold and transformative for silver. Stay educated, prepared, and thanks for watching.